Okay, good afternoon, everybody. Today is April 15th. It's Friday. The markets are closed today. So this is your weekly take on the markets. I will be your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at IBD. Here's the disclaimer, always the same. We're not licensed at IBD. Nobody is. We don't provide buy, sell, hold recommendations, just educational research purposes. You guys, hopefully we can help you to do this on your own. All right, we'll talk about the markets, industry groups, stocks to watch, and then the quote of the week, pretty much the same each week. So let's jump to the indexes. So here's a chart of the NASDAQ, and the NASDAQ is really very top heavy. It just can't get out of its own way. Thursday was a pretty poor day. I don't know if we're going to these lows, but it feels like a magnet to the lows. The NASDAQ is just loaded up with stuff that can't go up, and just looks like it's headed lower, and the components especially. So Microsoft, it just doesn't look very good. It looks like that's only 9 points away to making a new low. Microsoft's had some 9-point down days in the last couple of weeks, so that could be a single day. Just looks very top heavy. Amazon, this is what's that, 70 points or so to making new lows. Apple's holding up a little bit better, but Apple always seems to hold up a little bit better. It's like the place everyone can run and hide to, and it's just a cash cow. Such a great company, and the Swiss National Bank owns 4% of it, and Berkshire owns 4% of it, or whatever the numbers are. So there's a lot of this company is locked up. They're not going to sell. So I don't think I would buy Apple. But if you're an institution, you have to be invested. There's worse places to go, right? And it's the old adage, you're not going to get fired for owning Apple. You go out on a limb and own energy or coal stocks, and they fall apart. There's some risk there, which is probably why those are working, right? Because they don't have a lot of institutional sponsorship. Because they've just been totally underinvested in. I think, and we'll talk about stocks, but and gosh, I wrote it down, and what did I do with it? But I think in the 80s, energy was like 20% of the S&P 500, and in 2009 at the low, I think it was around 4% of the S&P, and even now it's only like 6 or 8. So it's barely scratched the surface as far as percentage. I don't know if it's going to 20, but can it go to 12 or 14 or something like that? Sure. So there could be a lot of room for that, for those to go. Now, we'll pull them up. They need bases. They need to consolidate some of their gains, but that's been the area that's worked all year. The NASDAQ just has not worked. It's just been a turkey, and this is turning out to be just a dead cat bounce or a bear market rally. The S&P is holding up a little bit better. Why? Well, because it has at least some exposure to energy, to materials. The NASDAQ composite does not. It doesn't have any exposure to that. So it's holding up a little bit better, although it did close below the 50-day. And I never look at the Dow. I think somebody mentioned the Dow the other day. I think it started up because Caterpillar and somebody else, maybe Nike or somebody, was up big. And but I did pull it up because the Dow had a big day. I think it was up at one point yesterday, 500-600 points. Look at the relative strength, so much stronger, but it's just a place to hide. I think it's not very innovative. They took out all the energy. They removed Exxon at the lows, give or take. So it's not really an index that we follow all that much. Although if, my uncle asks me how the market did, he wants me to tell him what the Dow did, right? So it's got a lot of staying power in that regard for the average person. They understand, the market as being the Dow. So that's fine. Emerging markets, not all that great either. They've got, the Chinese component, and Chinese stocks have not done that well, as everyone knows. So it's been some pockets of strength, and we'll go through them, and you've just had to be in those areas. I've been in those areas mostly. I've missed some of them. I haven't owned any coal stocks, but the one guy I follow on Twitter says the trade is long XLE and short ARC. That was, if you had that trade on, you'd almost be, market neutral, and you'd be up about 35% this year if it was just those two equally weighted. I don't know if you could put that on. I don't know if you can short ARC, but this is the bear market is in ARC. Let's go to the weekly. It's a nasty bear market, 55%, and maybe lower. Maybe it ends up lower. I don't know. And the bull market has been in XLE and other areas, but XLE in general, right? And it's partly what I've been doing last, 8-9 years, but really in the last 5 years, I really have just kind of ignored the indexes mostly. They're not, if I were to create a list of top 10 things that are most important in me building a portfolio, I don't know where the indexes it would fall, but they would not. I don't know if they'd make the top third. I just think that at least for me, the indexes they just do a good job of fooling me. And so I like to concentrate on the stocks I own, the stocks I wish I'd own, and go from there. And then I really believe position size is most important. Having the right stocks, having a position that's meaningful, but not too meaningful that you can't stand the wiggles. And that's the hardest part. I don't know what that number is. I'm always searching for it for myself, because when I have something and it's going up, I never own enough. And when I have something that's going down, I always own too much. So I'm trying to find a number and more rules-based that fits with my temperament, my personality. And so that's what I think about all the time when I'm building portfolios is, I want to own this stock. I think it's going higher. And when I think they're going higher, I always want to own, a zillion shares of it. But I have to understand that I might not be able to handle the volatility. So I'd rather have, I think was it Mark Minervini on IBD Live that said, I think it was him. Yeah, I know it was him. I'd rather have a small position in something that moved a lot than a big position in something I got shaken out of, right? And I lived it with CF. So I had a really big position in CF here in this kind of window right here, like the relative strength to me and the earnings and sales, and it just was screaming that it was going higher. And I was right. It was going higher. It's going a lot higher. It's 60 to 108. I think my first buy is in the low 60s. But I'm not there because I had too much of a position. So instead of a 35% position or some ungodly sum that, I want to have, why not have a 5% position or an 8% or 12%, something, and participate in it? So even a 3.5% position, 90% less position than 35% is better than what I have now because I have zero now. So that's how I think about the markets and where you want to be invested and all of that. The indexes are important because they're going to drive the stocks if it gets to that point, like really bad. If we're in a big bear market or big bull market, the indexes are going to move the stocks you're in, but the industry groups are so much, they're 50% weighting roughly on the move, maybe more. So it's best to concentrate in where the money is flowing. And And I think the indexes do a good job. Like right now, I think anything NASDAQ related to me is an avoid. I've tried some NASDAQ related stocks. I tried ACLS. That didn't work. I bought that this day, and it just was too volatile. I made a little bit of money, but great. I didn't lose what I could have, but my goal wasn't to try to make 3 points on a $70 stock. GFS, I tried that one. I think I bought it that blue day and got stopped out the next day. AOSL, I did not try that one because I owned the other two and just thought, do I need a third one? Glad I didn't. It rolled over. So, and then one that's got away a little bit was Shockwave. I bought that somewhere in here, and it worked. So I guess I could have kept that one, but it was a little squirrely, and so it knocked me out of the box. So anything NASDAQ related has been an avoid to me. I have been short some NASDAQ related stocks, but I don't have a lot of conviction to the short side due to sentiment. So this looks really negative to me, but I feel like the problem is sentiment. Everybody sees that. It's obvious that the NASDAQ is really negative. So I'm wary of these counter trend rallies. So I will put on a little bit of short once in a while, like a QID, which is a double short NASDAQ, or SQQ, which is triple short NASDAQ, or PSQ, which is single short NASDAQ. And I'm speaking in cash account terms because I can't short in my Roth IRA and my wife's IRAs, et cetera. But I haven't really been put pedal to the metal on those. Here's a chart of sentiment. This kind of is why confirming my feelings about being short. It's sentiment is pretty bad. So bullish sentiment this week ranks among the 10th lowest readings in the survey's history. So 15.8% of the AAII survey participants are bullish, just 15%. It's not super high bearish. They're 48%. And the neutral numbers, splits the difference. And this survey is not, I don't know how many people they're surveying. It's not like, it's 5,000 people or anything like that. But it's just, that's kind of what it feels like to me, that everyone's pretty bearish. NASDAQ type stocks, rightfully so, the way they're acting, they just can't go up, right? So this keeps me from being super bearish or in pressing to the downside. All the move, the bull market is in material stocks, and if you don't want to own those, if you want to be long innovation, which is great, I prefer to be long those types of companies. They're more fun. They're easier to understand. They're easier to differentiate, especially if you use one of their products or services. But I just want to make money. So I'm looking for stocks that are going up. Like Mark Minervini said, tennis balls. He's looking to buy tennis balls and sell eggs. Well, if you threw a tennis ball, what would it do? It would bounce. It'd bounce back, right? If you threw an egg, what would it do? It would splat, like PayPal. PayPal is splatted. It's gone down and just stayed down. So you want to buy. When I would go to seminars, there's I can't remember his last name, Ian. This guy he called it I buy rockets and sell rocks. Same thing. I buy stocks that go up rockets, and I sell rocks. If you throw a rock into a pond, it might skip for 2 or 3 tries if you're really good at it, but it ultimately is going to end up at the bottom of the pond. And that's what these tech stocks are doing. So sentiment's pretty bad for what it's worth. Let's go to the industry groups. Open stock ideas, weekly review, industry groups. Let me get this to fit the screen. That's weird. Why is that not fitting the screen? All right. I know why, because it wasn't being shared. Okay, great, thanks. So here are the industry groups. Let's go ahead and sort them. Energy coal is number 1, oil, gas, royalty trust, 2, chem, ag, 3, international, drilling, media, periodicals. Look, there's 3 stocks. You know, it's not going to, unless there was something like, I know for a while Apple was like 1 of 3 stocks, but mostly I'm going to ignore anything with that few stocks. Canadian, although it has only 6 stocks, has been a really good group. I do own a couple of Canadian oil and gas. Steel has been a good group. Oil and gas. Shipping, I do own a couple of shippers. And mining metal ores, you get it. Wow, it's just incredible where all of the groups are top heavy. You've got a couple maybe that are you've got ag operations. I do own a stock there. Food grain related. Don't have anything there. Utility, I do have one there. Own gas, machinery, equipment. So it just depends on how far down the food chain you want to go, but you see where all the strength is concentrated. Now, the longer they spend up here, the more likely that you've missed them, at least the first wave up. So, which is why this is important to be doing and looking and moving down the food chain and looking for groups that, you know, oh, if you've never, steel specialty alloys. I don't remember looking at that group, right? And see, last week it was 25. Currently it's 18. 3 months ago it was 96. If I don't know anything about that group, I better learn something. Double click steel specialty alloys, open up the related information panel, choose stocks and group. There they are in market cap order, but I want to review them in a better rating system. So I'm going to click show all component data. TMST is the first stock. Why? The combination of EPS and RS adds up to the highest number. So the EPS is low, but the RS is really high. That's what you've got 180 right there. And this one's what, 179, you get the idea. So TMST, double click. I think David Ryan mentioned this stock on IBD Live. It's a little thin, a $20 stock, 800,000 shares, but you know, huge earnings and sales and acting really well, setting up, you had a buy point. And so that's how you can find ideas in groups that you might not be following. So if you're doing that every week or every other week, you're not going to miss the next group. I don't know what the next group is going to be, but somewhere in here, there's a group that's currently 100 or 75 or 61 on its way to 1. And that might be 3, 6, 9 months from now. But if you're doing this all the time, eventually you'll kind of just stumble into it. And then it comes down to believing what you see. Because most people, oil and gas, coal, they just didn't believe it. That's why they haven't participated. I think that's partly why, if you go to this group, let's pull up, is it ACGL? Was that the stock? Oh no, that's Arch Capital. Arch Resources. Let's go to the weekly, and I'm just as guilty, you know, nowhere to be found on a name like this. So, you know, pretty tough to buy here, pretty tough to buy there. This one worked from 100 to 166, up 59%. So even though it seemed late here, it wasn't so late that you're up 59% in it. And the thing is there's very little, if any. I haven't looked, I promise you, but I am willing to bet $1 to a donut that there are 0 IBD mutual funds in this stock. Let's go ahead and check. Yeah, it's empty, right? IBD mutual fund index. I'm going to sort this based on the funds I like. And let's see if any of the funds that I like, which is more than just the IBD mutual fund index, have a position. So I have tabbed a ton of Fidelity funds and none of them have a position. So nobody's really been here. How about CEIX? Nobody there either. And that's partly why I've missed them myself too, is because I didn't understand why maybe, you know, nobody had any interest in it. Like, is it CNQ? at least for a little bit. It looks like he's removed the position. Oh no, Contra has so you can see here I have Fidelity Advisor, Fidelity Contra, Fidelity Growth, but when C&Q breaks out and Contra has a fund, then that gives me the conviction I can go with that. If not there, I don't think I think it was here. So I like to see at least some sponsorship. And that's kind of kept me out of the calls, unfortunately. I don't have to have sponsorship, but I really want to get at least some sponsorship. And remember, sponsorship works both ways. These guys, when these stocks roll over, if you look at Twilio, and this is a good exercise you should do to understand how stocks come and go. You've still got a lot of this sponsorship from these guys. Look at the number of funds. So in June of 2020, right there, somewhere in there, you had 1,200 funds. And then a quarter later, you had 1,375, right? Quarter later. Who moved that stock there to there? Then, the 300 plus net new funds. And then December to 20 there, you have another 200 plus funds, right? And then March, another 160 funds. And so that's where, and there's no magic number. But you should know, well, when was the time to buy Twilio? Either here or here or here. And now it's, the funds are starting to really pile up. And then this is kind of your clue after the fact. June 21, you lost 8 funds right in there. So it's slowing down. You're not getting any new, there's no new funds building the positions. And after a while of this, maybe some of these guys and gals decide, let's move on from Twilio. I want the money someplace else. And then the next September 21, very subtle again, but you've lost another 4 funds. So now you have a stock's gone sideways for months and it's losing fund ownership. And then December 21, by the time you get that news, if you're not reading the chart, you've lost over 100 funds. Well, who did this? Who caused that sell off down from 300 to 200? These guys and gals getting out. And now here in March, you're down to another 29 funds. So I will look for like the flow. I remember, and I didn't handle it super well, but with team here, the funds were just ridiculous. It was like 130 to 300 to 412 to 670, and it just was just relentless fund ownership increasing on the way up. So these are important factors to help you kind of, if you're a long-term holder, which I'm not very good at, but I'm trying to get better at, manage your position by following what the funds are doing. And there's a lag for sure. They're not going to call you up and tell you that they're dumping, but you notice with Twilio, you didn't need to know, right? If the stock went from 100 to 400 and then went sideways between 300 and 350 for months and months and months, losing relative strength, not participating in the market rally. And then when you get that information, when it comes in, you're noticing the lack of increasing fund ownership. In fact, it's decreasing. These could be used for long-term, sell signals if you're trying to hold a really, really big winner. All right, sorry, I kind of went off on a tangent, but it was I felt like sometimes I do that in this video, and that's important. So the main thing is, where's the strength? Coal, energy, right? CEIX, EQT. Look at these stocks. Look at these breakouts. I know people say breakouts don't work. Well, they don't all work, but that's pretty good. 75%. You haven't had a down week. I don't know. That's pretty good action. Shipping, especially liquefied natural gas, 26% in 4 weeks. GLNG broke out a little bit sooner, 81% in 11 weeks. So that's another area. I know GNK, which I own, which was really difficult. It was a little sloppy coming out of this area. I think I owned it somewhere in there. And this was really tough, and this was tough. And I feel like I sold some. Well, I know I did. I can't remember what percentage, but I did get shaken out of some of it, which is what I'll do. If I feel like, oh, it hasn't hit my stop, but I don't like the action, I will reduce and hope I'm wrong. So I have some really bad sells in GNK. I think it was this day, or maybe it was that day, but it's a bad sell considering where the stock is now. That's fine. I still have the other shares. I'll live with those bad sells in case it keeps going down. So that area is acting really well. And then energy, take your pick. Here's PDCE, broke out of the ascending base. Devon has been an incredible leader. Suncor, I think I mentioned that last week. So there's places to be invested. You could and I hate to say should be making progress this year. I don't know if you're going to be lighting the world on fire if you're a Can Slim investor, because it's kind of hard to wrap our mind around the sea change that might be going on in the market. These areas have been way underinvested in for years and years and years. And maybe there's something big happening here. It's possible. I don't know, but I'll ride them until proven otherwise. All right, so those are some stocks that I've been watching that I'm looking at. I think those are all the stocks I wanted to mention. Let's go to the quote of the week. Podcast, or was it a podcast? It was a video cast. It was very similar to podcast, but Buddy Carter, he basically makes his living from trading the market, which is, I have a lot of respect for people that do that, because I did that for a long, long time, and it's hard. It's it's not easy to do. Put your kids through school and feed your family. Killing what you eat, so to speak, from the market. But Buddy Carter started out at Goldman Sachs, and now he just does this on his own. And he said, I always tell a story. The first time I had dinner with Stan Druckenmiller, I sat next to him. I said, Stan, could you tell me about your investment process? And he says, sure, yes. I bet 8% to make 25%, and I try to stay in front of the mutual funds. It was like Stan Druckenmiller had read How to Make Money in Stocks. And he followed this up with when he went back to the office, and everybody was so curious about, Stan Druckenmiller, because his track record is legendary with as far as having big money. He's on he's the Mount Rushmore of investing. All his colleagues said, what was Stan like? And he said, he's really tall and he talks in percentages. That was what he remembered most about him. So I don't really care what I'm buying. I'm betting 8% to make 25%, right? That's what we're doing over and over and over. And then what made me go off on that tangent on the mutual funds with the Twilio example was we're trying to stay in front of those guys and gals, either on the way up and definitely on the way down. They're battleships. They can't change direction, right? And we're PT boats if you're managing a PA, your own money. And so they have some advantages for sure, but we definitely have advantages in being able to change and move and flexibility much more quickly than them. So, I can easily build a 20% position in XYZ in a nanosecond compared to how fast Fidelity Contra can build a 5% position in XYZ. And so we want to be watching those guys, and you're risking some percentage to make something more. In this case, triple, right? It's the same thing that Bill would use. The 20 to 25% target, risking 7%, from the book. I think the reason we have 5 to 8% in Market Smith as the shaded area is when they studied Bill's trading account, his account, all those years, most of his trades, his losers were around 5%. So you don't have to wait for 7 to 8. That's your alarm bell. Feel like something's wrong, you can take it off at 4, you can take it off at 5, you can take it off at 3. You got to give it a little bit of room to breathe. Like GNK is a good example. Sometimes I take them off at 1 or 2%. And that's just not, sometimes I'm glad I did, like GFS. I took that off really quickly at a small loss, 1 or 2%. I don't remember, but GNK took that one off at 1 or 2%. And that portion is much higher. So you want to give them a little bit of room to breathe. So, some percentage. I think 5 is probably low end, and I think 8 is high end. That's why I like that range based on your trading, acumen, and how much you watch, and how big your upside target is. You could even do some combination, maybe take off half at 5 and take off half at 10. And you then, if you got stopped on both, you're going to lose 7.5%, on both those. Take off a half take off a quarter at 40%, take off another quarter at 60% down, not 60%, but I'm thinking a quarter of 8%. So let me rephrase that. Take off a quarter of the position. Let's say I have 1,000 shares and stocks 100. You could do 250 at 96, 250 at 95, and 500 at 91. It's fine. There's nothing wrong with that. And in this day and age of zero commissions, that's all the same trade. But have some type of plan, that's for sure. All right. Thank you guys for your time. We do have some new features in MarketSmith, and we'll come out with a video to talk about them. I was going to mention them fairly quickly. I apologize. This ran much longer than I expected, but we are going to do a video probably early next week with some of those features. If we don't get the video out next week, I'll address them in next Friday's Take on the Market. Our contact information, we have a new email. Please use this one instead of the Reach Us. The Reach Us will still work, but ultimately it's going away. So you'll want to take note of this new email, marketsmith@investors.com. Phone number is the same. Have a great weekend, everybody, and appreciate your time. Bye-bye.